In this video we are going to talk about 15 dividend stocks that pay monthly dividends. So before starting this video, please like this video and subscribe to this channel for our future updates. Number 15. Realty Income. No other stock has been more closely related with monthly dividends than Realty Income, $70.91. The monthly dividend company even trademarked its official nickname. Of course, Realty Income is a stock, and its share price fluctuates like any other. But it's still the closest thing to a bond in the stock market. It offers reliable recurring rental income from over 7,000 homes and 650 renters. Among its major tenants are 7-Eleven, Walgreens Boots Alliance, FedEx, and Home Depot. The portfolio had strong exposure to gyms and cinemas, making the pandemic difficult. But as the world returns to normal, Realty Income's COVID-19 risk decreases. Realty Income currently yields around 4.2%. Remember that the 10-year Treasury yields only 1.6%. Number 14. Stag Industrial. Stag invests in warehouses and light industry. Those rundown warehouses near the airport with 18-wheelers continually coming and going? Stag acquires and holds property like that. E-commerce is unquestionably on the rise and Stag is well positioned to benefit. Amazon.com is Stag's largest tenant, accounting for over 40% of its property. For obvious reasons, e-commerce soared. The impacts of that rise have faded as businesses reopen, but the trend is obvious. We're buying more online. But there's more to come. According to Statista, only 15% of retail sales are conducted online. The logistical industry is also highly fragmented, with Stag's management estimating a market value of roughly $1 trillion. That is, Stag is unlikely to run out of opportunities soon. Number 13. Gladstone Commercial. Consider Gladstone Commercial, good, $22.49, for another grim industrial piece. We have a broad portfolio of logistics and light industrial properties. Industrial properties generate roughly 48% of its rental income, while office properties generate another 48%. The remaining 4% is split between retail properties, 3%, and medical offices, 1%. It's a well-diversified portfolio that has weathered the recent market turmoil. On September 30, 2021, the REIT had 127 properties in 27 states leased to 109 tenants. We have grown our portfolio 18% every year since our IPO in 2003, says management. Our occupancy is 97.7% and has never been below 95%. Number 12. ERP Properties. The COVID-19 outbreak hit many landlords hard. But none was hammered like EPR Properties, EPR, $49.21. EPR's portfolio includes movie theaters, amusement parks, ski resorts, eat and play venues like Topgolf, and more. EPR focuses on experiences above stuff, which is a bad idea when social distance is the norm. Almost every EPR site was closed for a while, and attendance haven't returned to pre-COVID levels in many. Number 11. LTC Properties. Consider LTC Properties, LTC, $34.24, for a final conventional REIT. Although the pandemic's consequences are still persisting, LTC's outlook remains positive. LTC is a REIT with a portfolio that includes both senior housing and nursing homes. COVID-19 hit this area hard. Nursing facilities were prone to breakouts, and inhabitants were at risk due to their age. The residents in senior living apartments are often younger and live freely without medical care. But many prospective tenants were afraid to leave their houses and move into a more crowded building during a pandemic. Many are still. Number 10. AGNC Investment. AGNC Investment, AGNC, $15.98, is a REIT, but it's not like Realty Income, Stag, or any of the other monthly dividend companies on this list. Rather than owning real estate, AGNC owns mortgage securities. It has the same tax benefits as a REIT, no federal income taxes if at least 90% of net revenue is distributed as dividends, but a significantly different return profile. Mortgage REITs are meant to generate income rather than capital gains. They are hence monster yielders. For example, AGNC generates 9%. Number 9. Dynex Capital. Consider Dynex Capital, DX, $17.47. Dynex, like AGNC, is a mortgage REIT, although its portfolio is broader. About 85% of its portfolio is agency residential mortgage-backed securities, although it also has exposure to commercial mortgage-backed securities and a modest allocation to non-agency assets. Remember that the COVID-19 bad market wiped out the mortgage REIT sector. Initially, it was unclear if millions of Americans would be able to keep paying their mortgages, leading speculators to sell first and ask questions later. In the ensuing carnage, several mortgage REITs suffered catastrophic losses, and some folded. Number 8. BROADMARK Realty. In fact, BROADMARK Realty, BRMK, $9.75, doesn't own mortgages or mortgage-backed securities. But it does a lot of the same. BROADMARK administers a portfolio of deed of trust loans for real estate development and investment. Unlike AGNC or Dynex, these mortgage REITs mostly trade standardized MBS. Instead, BROADMARK deals with less liquid construction loans. Number 7. Main Street Capital. Main Street is Wall Street. BDCs primarily fund middle-market companies through debt and equity. These are companies that have grown too big for bank loans and maintained earnings, but not big enough for a stock or bond IPO. BDCs fill that void. Number 6. Prospect Capital. Consider Prospect Capital, SEC, $8.97, for another high-yielding BDC. Prospect Capital, like most BDCs, lends to middle-market companies. The company has been publicly traded since 2004, thus it has survived 2 tumultuous decades. Prospect Capital trades at just 89% of book value. Of course, book value is subjective. But the 11% allows us some leeway. Even under modest assumptions, the company is selling for less than the value of its core portfolio. It likewise produces 8%. Number 5. Ecofin Sustainable and Social Impact Term Fund. Orphan stocks have merit. Certain companies or funds just don't have a typical buyer. Consider the Ecofin Social Impact Term Fund, TEIF, $15. In this fund, traditional energy infrastructure like pipelines meets green energy initiatives like solar panels. Other impact sectors include education and senior living. Some 68% of the portfolio is sustainable infrastructure, with 13% and 19% of the portfolio being energy infrastructure. Number 4. BlackRock Municipal 2030 Target Term. The fund is intended to be liquidated in 2030 or around 8 years from now. Sure, 8 years is a long time. Buying a portfolio of safe municipal bonds trading at a 4% discount to book value seems prudent. The main attraction of muni bonds is the tax-free income. The bond interest is tax-free. The US government can claim risk-free city, state, and local bonds, but defaults and financial difficulties are unusual. So you get a tax-free dividend. That's not bad. Number 3. Horizon Technology Finance Corp, HRZN. Horizon Capital, as the name implies, is a financing and investment firm that focuses mostly on the technology sector. In contrast to standard Silicon Valley outfits, the footprint of this corporation is firmly focused on life sciences and biotechnology. Castle Creek Biosciences, a developer of rare disease treatments, and CSA Medical, a manufacturer of respiratory devices, are 2 examples of companies in which HRZN has invested. These kind of development stage pharma firms or specialty medical device companies are fraught with danger, but they have the potential to be extremely profitable if and when they succeed in their respective fields. A diverse portfolio, which helps to level out some of the volatility in individual investments, has allowed HRZN to outperform the S&P 500 by 35% year to far, including dividend payments. Number 2. PennantPark Floating Rate Capital, PFLT. PennantPark is an intriguing monthly dividend stock to explore right now, especially considering the widespread belief that interest rates will rise in the near future. A lender to failing firms, PFLT invests its resources at high interest rates to mitigate the greater levels of risk associated with these enterprises. Many businesses, as you might guess, struggled during the pandemic, and PennantPark made some astute and strategic decisions during that period. Its floating rate loans, in addition, shift upward in response to changes in the broader rate environment, which means that PFLT will face even higher interest payments in the event of a rate increase in the future. Since the beginning of the year, this monthly dividend stock has gained around 36%, including dividends, and it also has one of the highest yields on this list to boot. Number 1. Stellus Capital Investment Corp, SCM. Stellus Capital's dividends decreased from around 31 cents per month to 10 cents per month around a year ago, causing the stock to plummet. However, the share price of this financial company has recovered significantly, from lows of less than $10 for much of 2020 to around $13 per share now. SCM concentrates on private middle market investments and invests via first lien and unitranche financing, which means it is the sole lender in a debt issue and so has more control over payment terms. SCM services a risky segment of the market, as so-called lower middle market enterprises lack the huge funds and well-established operations of multinational blue-chip stocks. As a result, this monthly dividend stock can command a higher premium on its loans, resulting in higher dividends. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.